I need you to stop whatever you're doing right now. Put down your phone, close your laptop. Tell your family that you can't talk because you need to understand what just happened while you were sleeping. Because in the last 36 hours, the financial world didn't just shift, it capitulated. It didn't crash in a dramatic explosion that makes headlines. It bled out slowly through the weekend when nobody was watching, when liquidity was thin, when the world's attention was elsewhere. And the man who bet everything on Bitcoin, Michael Saylor, the corporate evangelist who convinced the world that orange coin was digital gold, just watched his $55 billion position go underwater for the first time in over a year. Ladies and gentlemen, this is not a correction. This is not a healthy pullback. This is total capitulation. And if you don't understand what happened this weekend, you're about to get blindsided by what's coming this Monday morning. It is Monday, February 2nd, 2026. The markets are about to open. The trading floors are preparing for chaos. This should have been the quiet time after a weekend. The time when institutional players regroup, when algorithms recalibrate, when the world takes a breath before the week begins. But this weekend, something broke. Something that should never break in a functioning market. Bitcoin, the asset that was supposed to be digital gold, the hedge against inflation, the refuge from government control, just plunged to $74,662 on Sunday. Not $74,900. Not $75,000. Exactly $74,662.80. And in that moment, it triggered one of the largest weekend liquidation events in cryptocurrency history. Approximately $2 billion in leveraged positions, gone, vanished, evaporated in thin air while most of America was planning their Sunday brunch or recovering from Saturday night. But here's what you need to understand. This wasn't an accident. This wasn't some random black swan event that nobody could have predicted. This was a precision surgical strike on the most over-leveraged, overconfident, overexposed position in the entire crypto market. And the patient on the operating table? Michael Saylor's strategy, the company formerly known as MicroStrategy, with 712,647 Bitcoin purchased at an average price of $76,037 per coin. Do you see what just happened? When Bitcoin hit 74,662 on Sunday, every single one of those 712,647 coins went underwater. Not by a little. We're talking about unrealized losses that peaked at nearly $980 million. Almost $1 billion in paper losses. In a single weekend. Let me break down exactly what this number means, because unless you understand the mechanics of how modern crypto markets work, you're going to miss the significance of what just transpired. When Bitcoin trades at a certain price, that's not just some abstract number on a screen. That's the clearing price, the point where buyers and sellers agree to exchange value. In normal market conditions, this price moves smoothly. A few dollars up, a few dollars down. Supply and demand finding equilibrium. But when Bitcoin drops from 85,000 to 74,662 over a weekend, that's not normal price discovery. That's forced liquidation. That's what happens when leveraged positions get margin called and traders who bet with borrowed money are forced to sell at any price, regardless of what they think Bitcoin is worth. Strategy holds 712,647 BTC. Think about that number for a second. That's not a trading position. That's not some hedge fund making a speculative bet. That's a publicly traded company that has spent $54.19 billion, billion with a B, acquiring Bitcoin at an average cost of $76,037 per coin. This is their entire strategy. They don't mine Bitcoin. They don't build Bitcoin infrastructure. They buy Bitcoin and hold it forever. That's the Michael Saylor playbook. Bitcoin is the apex property of the human race, and we will never sell. Well, when the apex property of the human race trades below your cost basis, you have a problem. Not an immediate solvency problem. Strategy's debt isn't callable. They're not facing margin calls. They have $2.25 billion in cash reserves, but they have a capital problem. Because when your stock trades at a discount to your Bitcoin holdings, you can't issue new shares to buy more Bitcoin without diluting your shareholders into oblivion. Here's the brutal arithmetic. 712,647 BTC times $76,037 average cost equals $54.19 billion total investment. And when Bitcoin hit 74,662 on Sunday, those same coins were worth approximately $53.2 billion. That's a $980 million hole. Not a realized loss. Saylor hasn't sold a single Satoshi, but a paper loss that every analyst, every shareholder, every creditor can see on the balance sheet. And here's the thing about paper losses in public markets. They become real very, very quickly when confidence breaks. Before we continue, I need to know, do you think Saylor will hold through this, or will Strategy be forced to sell? Drop your answer in the comments. Type hold if you think he keeps his conviction, or sell if you think the pressure breaks him. And if you want to see how this plays out in real time, hit that subscribe button because this story is far from over. So what caused this? What triggered the most violent cryptocurrency sell-off since the FTX collapse? The answer isn't simple, and that's exactly what makes it so dangerous. This wasn't one thing going wrong. This was a perfect storm of 5 catastrophic factors converging in the same weekend window. Reports emerged on Friday of escalating tensions between the United States and Iran. Not rumors, not speculation. Actual military posturing that sent risk appetite into the freezer. And when geopolitical fear hits, capital doesn't flee to Bitcoin. It flees to the US dollar. Bitcoin, despite the digital gold narrative, got treated like a risk asset, like tech stocks, like emerging market debt. It got sold first, sold hard, sold without mercy. On January 28th, Fed Chair Jerome Powell held rates steady and made it crystal clear, we're not in a hurry to cut. That wasn't dovish, that wasn't neutral, that was a hawkish message wrapped in polite central banker language, higher for longer. Real yield staying elevated. The opportunity cost of holding a non-yielding asset like Bitcoin just got more expensive. This is where it gets technical, and this is where most people don't understand what happened. Bitcoin trades 24 hours a day, 7 days a week, 365 days a year. But liquidity, the depth of buy and sell orders sitting on exchanges, is not constant. Weekend liquidity is typically 30 to 40% thinner than weekday liquidity. Saturday and Sunday liquidity, even worse. When the selling started Saturday morning in Asia and accelerated through Sunday, there weren't enough buyers. The bids evaporated. And when bids evaporate in a leveraged market, price doesn't drift lower, it gaps, it teleports. We saw $3,000 candles in minutes, not because of new information, because there was nobody standing on the other side of the trade. US spot Bitcoin ETFs have been hemorrhaging capital. In January 2026 alone, approximately $1.6 billion in net outflows. On Thursday, January 29th, nearly $818 million exited in a single session, one of the worst single days on record. BlackRock's IBIT lost $317.8 million. Fidelity's FBTC bled $168 million. Grayscale's GBTC saw $119.4 million walk out the door. This matters because ETFs were supposed to be the institutional on-ramp, the smart money buying Bitcoin. When that flow reverses, it's not just retail panic selling, it's institutions reducing exposure, rebalancing portfolios, cutting risk. It's a different animal entirely. According to CoinGlass and multiple sources, approximately $1.7 to $2.2 billion in leveraged long positions were liquidated over Saturday and Sunday combined. Let me repeat that. Nearly $2 billion. That's more than most single-day liquidation events in crypto history. This was one of the largest weekend crypto liquidation catastrophes ever recorded. One trader on Hyperliquid reportedly lost over $200 million on a leveraged Ethereum position. Gone. Wiped out. Because when you're leveraged 10 times, 20 times, 50 times, you don't need Bitcoin to go to zero. You just need it to move 5 to 10% against you. And the exchange force liquidates your position. These 5 factors didn't happen in sequence. They happened simultaneously. And when they collided with thin weekend liquidity, Bitcoin didn't just fall, it collapsed. Now let's talk about the elephant in the room. The man who made corporate Bitcoin accumulation respectable. The man who convinced boardrooms across America that Bitcoin deserves a place on every balance sheet. Michael Saylor. Since August 2020, Saylor has been on a mission. An almost religious crusade to accumulate as much Bitcoin as possible using every financial engineering tool available. Convertible debt, at-the-market equity offerings, preferred shares with 11.25% dividends. He turned strategy from a struggling business intelligence software company into a Bitcoin treasury company with over 700,000 coins. And for most of that journey, it worked. Bitcoin went up. The stock went up. Saylor became a folk hero in the crypto community. The ultimate diamond hands, the man who would never sell, the conviction player who saw what others couldn't. But conviction doesn't pay the bills when your position goes underwater. When Bitcoin dipped below 76,037, Strategy's average purchase price, something psychological shifted in the market. It's one thing to hold an asset through volatility when you're sitting on unrealized gains. It's another thing entirely when you're staring at nearly $1 billion in losses. Now, Saylor has been quick to remind everyone, we don't have margin calls. Our Bitcoin is unencumbered. We face no forced selling even if Bitcoin goes to $1. And technically, he's right. Strategy's debt structure is built to weather exactly this scenario. They have $8.2 billion in unsecured convertible notes, none of which can force them to sell Bitcoin. They have $2.25 billion in cash and cash equivalents. But here's what the financial engineering can't fix. When your stock trades at a discount to your net asset value, you lose your primary funding mechanism. Strategy's entire model depends on issuing new shares when the stock trades at a premium to NAV. Here's how it works. If the stock is trading at 2 times the value of their Bitcoin holdings, they can issue $100 million in new shares, buy $200 million worth of Bitcoin, and increase the Bitcoin per share for existing shareholders. It's accretive, it's value creating, it's genius. But when the stock trades at a discount to NAV, which it currently does, that math flips. Issuing new shares becomes dilutive. It destroys shareholder value. It makes the problem worse, not better. And that's exactly where Strategy finds itself right now. The MSTR stock is down approximately 46% year to date. The preferred stock, which they just raised the dividend to 11.25% to try to attract buyers, has been trading below its $100 pair value. Saylor posted more orange on X on Sunday morning, his typical signal that another Bitcoin purchase is coming. But the market knows that this purchase, if it happens, will be small, constrained, limited by the reality that their capital raising machine has stalled. This is the market's way of testing Saylor's conviction. It's one thing to be a Bitcoin evangelist when the price is going up. It's another thing entirely to stay the course when you're underwater, your funding is constrained, your stock is cratering, and the leverage structure you built is facing its first real stress test. And here's the brutal truth that nobody wants to say out loud. If Saylor can't keep buying, the market loses one of its largest marginal buyers. And in a market that's already bleeding from ETF outflows and retail capitulation, losing that bid is like pulling a support beam out of a collapsing building. And let me explain exactly how nearly $2 billion in value disappears in a weekend, because this is where most people completely misunderstand how modern crypto markets function. Imagine you're a trader. You have $10,000 in capital, but you don't want to just buy $10,000 worth of Bitcoin. That's boring. So you go to an exchange that offers 10 times leverage. Now your $10,000 can control $100,000 worth of Bitcoin. If Bitcoin goes up 10%, you just doubled your money. Genius, right? Except it works both ways. If Bitcoin drops 10%, you just lost your entire $10,000. And here's the critical part. The exchange does not wait for you to decide to close your position. When Bitcoin drops to the point where your losses would exceed your capital, the exchange force liquidates you. They automatically sell your position to protect themselves from you owing them money. Now multiply that by hundreds of thousands of traders, all with different liquidation prices, all stacked on top of each other like dominoes. According to CoinGlass data, approximately 267,000 to 335,000 traders were liquidated over the weekend. Hundreds of thousands of individual positions, forcibly closed by exchanges. Over 90% of these were long positions, people betting Bitcoin would go up. The largest liquidation cluster sat around $85,000. That's where most of the late bulls had their stop losses. When Bitcoin broke through 85,000 on Saturday, those positions got liquidated, creating selling pressure that pushed the price to 83,000, which triggered the next cluster of liquidations, which pushed it toward 80,000, which triggered more liquidations. This is what traders call a cascading liquidation event. Each wave of forced selling creates the conditions for the next wave. It's a self-reinforcing downward spiral that doesn't stop until either you run out of leveraged positions to liquidate, or buyers step in with enough capital to absorb the selling. Over Saturday and Sunday, we didn't have enough buyers. The selling continued all the way to 74,662 before finally exhausting itself on Sunday afternoon. Bitcoin wasn't even the worst performer. Ethereum saw approximately $961 million in liquidations, actually more than Bitcoin in absolute dollar terms. Ethereum's liquidations accounted for roughly 44% of the total weekend carnage. One whale on Hyperliquid held a massive leveraged ETH position with significant unrealized profits. They watched that profit evaporate, then watched their entire position get liquidated, a massive loss on a single trade. This is what happens when conviction meets leverage meets reality. The market doesn't care about your thesis. It only cares about your margin. Why did this happen over a weekend? Because the weekend is when predators hunt, when liquidity is thinnest, when retail traders are watching, but institutional desks are closed, when the normal stabilizing mechanisms of the market makers, the arbitrage bots, the large liquidity providers, are running on skeleton crews or completely offline. If this exact same selling pressure had hit on a Wednesday at 2 p.m. Eastern Time, with full institutional participation and deep order books, Bitcoin probably would have found support around $80,000 to $82,000. But starting Saturday morning in Asia and continuing through Sunday, the market structure couldn't handle it. The bids evaporated. The price went into free fall. And here's the darkest part. There are whispers in the trading community that this was accidental, that sophisticated players knew exactly when to strike, that the geopolitical news provided the perfect cover for a coordinated assault on over-leveraged longs during the most vulnerable time window of the week. I can't prove that. I don't have evidence of manipulation. But I can tell you this. The timing was too perfect. The liquidation cascade too clean. The weekend liquidity vacuum too convenient. Now let's talk about what this means for anyone who's still holding Bitcoin, anyone who's thinking about buying Bitcoin, and anyone who thinks this is just another dip to buy. US spot. Bitcoin ETFs are now trading significantly below their average cost basis. The implied average entry price across all ETF investors is well above current levels. With BTC at 76,000, many ETF investors are underwater. Not by a little, by double digits. Think about what that means for institutional money managers. If you're a wealth advisor who recommended Bitcoin ETFs to clients in late 2024 or early 2025, your clients are down substantially. They're not happy. They're questioning your judgment. They're asking if they should sell, and some of them are selling. This creates a feedback loop. Redemptions force ETF sponsors to sell Bitcoin to meet those redemptions, which puts more downward pressure on price, which creates more unrealized losses, which triggers more redemptions. It's a death spiral that only stops when either price stabilizes and stops falling, or all the weak hands have been shaken out. We're not at stability yet. And we haven't hit maximum weak hand capitulation yet, which means more pain is coming. When Bitcoin bleeds, altcoins hemorrhage. Ethereum is down significantly over the past week. Solana, which was trading above $100 just days ago, has been struggling to maintain that psychological level. But it's not just the majors. The total crypto market capitalization has shed hundreds of billions since recent highs. Hundreds of billions of dollars. Gone. Glassnode data reveals a stark divergence in on-chain behavior. Small holders, wallets with less than 10 BTC, have been persistently selling for over a month. These are the retail players, the people who bought at 100,000 plus thinking Bitcoin was going to 250,000 by end of year. They're capitulating. They're admitting defeat. They're taking their losses and moving on. Meanwhile, the mega whales, wallets holding 1,000 plus BTC, have been positioning themselves. They're moving coins to exchanges in preparation. But here's the problem. Their accumulation hasn't been enough to arrest the decline, which tells you just how overwhelming the selling pressure has been. Markets open in just hours. The electronic Globex session kicks off Sunday evening when Asian markets wake up. And when that happens, we're going to see one of two scenarios. The dead cat bounce scenario. Shorts take profit, whales step in with size, and we get a relief rally back toward 80 to 82,000. This would be healthy. This would suggest we found a bottom. But it would be temporary, a reflex bounce before potential further downside. The flush continues scenario. Support at 74,000 breaks, we plunge toward 70 to 72,000, and the liquidation cascade resumes. This would be the true capitulation event. This would be where even the strong hands start to question their conviction. My money is on vulnerability to further downside, because the selling pressure hasn't been relieved. It's been compressed. All those leveraged longs that managed to survive the weekend by adding margin, they're one more 5% move away from getting liquidated. And once we break 74,000, there's not much support until 70,000. But this isn't just about Bitcoin. This isn't even just about crypto. What we're witnessing is a broader unraveling of the everything rally that's been propped up by cheap money and infinite liquidity since COVID. When Jerome Powell held rates steady on January 28th and said, "We're not in a hurry to cut," he was sending a clear message. The Fed put is gone. The automatic assumption that the central bank will step in to support asset prices when markets get volatile, that's over. This is a paradigm shift. For the last 15 years, since the 2008 financial crisis, markets have operated under the assumption that if things get bad enough, the Fed will ride to the rescue. Lower rates, print money, do whatever it takes. That embedded confidence created moral hazard. It encouraged risk-taking. It rewarded leverage. Now, the Fed is telling you you're on your own. With 10-year Treasury yields elevated and inflation concerns persisting, real yields remain significant. That means you can park your money in risk-free government bonds and earn a real return above inflation. Why would you take Bitcoin risk? With all its volatility, all its regulatory uncertainty, all its weekend liquidation cascades, when you can earn positive real yields in treasuries with zero stress? This is the question that institutional allocators are asking. And increasingly, they're choosing treasuries, hence the ETF outflows. There's a structural problem in crypto that has gotten worse since October 10th, 2025. That was the day of the infamous liquidity crisis, one of the largest single-day liquidation events by dollar value in crypto history. Bitcoin dropped substantially. Binance, the world's largest exchange, became the focus of the crash amid accusations of internal system issues. Since that day, liquidity has never fully recovered. Order books are thinner. Market depth is weaker. Bid-ask spreads are wider. The market's ability to absorb large orders without moving price has been permanently damaged. Analysts have described it as a system failure that triggered massive deleveraging. Binance denies it, but here's what's undeniable. Trust has been damaged. Market structure has been weakened. And that weakness is why this weekend's selling pressure created such outsized price moves. U.S.-Iran tensions aren't going away. If anything, they're escalating. Tariff threats and trade tensions are creating supply chain inflation fears and slowing global growth expectations. Every time geopolitical risk spikes, Bitcoin sells off. Not because it's not a hedge, but because in the short term, it's treated as a risk asset. Traders sell first, ask questions later. Here's where it gets really interesting. Because while retail is capitulating and institutions are reducing exposure, there's a different story playing out beneath the surface. On-chain data from Glassnode shows that wallets holding 1,000 plus BTC have been positioning. During the worst of the sell-off, when price was plunging and panic was peaking, these mega whales moved billions of dollars worth of Bitcoin. Some interpret this as distribution, but look closer at the timing and direction. They're moving coins to exchanges, transferring from cold storage to trading accounts. That's the step that happens before significant accumulation. They're preparing ammunition. Why? Because experienced Bitcoin whales know something that retail doesn't. The best accumulation opportunities come during maximum fear. When fear and greed index hits extreme fear, currently in the low 20s, when everyone is convinced Bitcoin is going to zero when leverage has been flushed and weak hands have been shaken out, that's when smart money backs up the truck. Strategy isn't the only corporate treasury holding Bitcoin. Metaplanet, the Japanese company, has reported significant unrealized losses on their Bitcoin position, but they're not selling. They're treating it as a long-term strategic asset. Mara Holdings holds approximately 53,250 BTC. They're mining more every day. They haven't sold. These corporate treasuries aren't traders. They're not trying to time the market. They're accumulating on weakness because they believe in the long-term thesis. Bitcoin is harder, scarcer, and more predictable than fiat currency. Small holders, the ones with less than 10 BTC, are selling. They've been selling for over a month. The ones who bought at 100,000 plus are taking massive losses. The ones who use leverage are getting liquidated. The ones who bought the digital gold narrative from influencers are feeling betrayed. This is the capitulation phase. This is what it looks like when weak hands get flushed out. It's painful, it's brutal, it's necessary, because Bitcoin doesn't reward weak hands. It rewards patience, it rewards conviction through volatility, and it rewards those who buy when blood is in the streets, even if that blood is their own. For those who care about charts and technical analysis, the picture is concerning, but it's also telling a clear story. Bitcoin broke below the 100-week simple moving average around $85,000. This is a level that has historically held during corrections. When it breaks, it signals that the correction is deeper and more serious than a typical bull market pullback. The next major support, the 200-week moving average, currently sitting near $58,000. If we reach that level, we're talking about a massive drawdown from the recent highs. That would qualify as a full-blown bear market. The 50-day moving average has crossed below the 200-day moving average, the infamous death cross. Technical traders view this as a bearish signal suggesting sustained downward momentum. Now, does this always work? No. In fact, death crosses have given false signals before in crypto, but combined with the macro factors, the liquidation data, and the on-chain metrics, it's confirming what the market structure is screaming. We're in a downtrend. Trading volume during the sell-off has been elevated but not extreme. That's actually concerning. It suggests this isn't panic capitulation yet. True capitulation comes with massive volume, everyone running for the exits at once, creating the kind of exhaustion that marks a bottom. We haven't had that volume spike yet, which means we probably haven't seen the true bottom. The relative strength index on daily charts is approaching oversold territory, but it's not there yet. Bitcoin can remain oversold for extended periods during bear markets. Just because RSI is low doesn't mean it can't go lower. There's a before and after in this market. And the dividing line is October 10th, 2025. Before October, crypto markets were deep, order books were robust. You could move substantial capital without significantly impacting price. Market makers were confident. Arbitrage was efficient. The system worked. Bitcoin was trading near all-time highs. ETFs were seeing consistent inflows. Strategy was raising capital effortlessly and accumulating BTC regularly. The narrative was strong. Institutional adoption, sovereign adoption like El Salvador with others. Considering inflation hedge, digital gold. Then came October 10th. The massive liquidation event, accusations of exchange failures, confidence shattered. And critically, liquidity never came back. Today's market operates with significantly less depth than pre-October. That means the same selling pressure creates much greater price impact. That means volatility is amplified. That means weekend sell-offs can create extreme moves instead of moderate corrections. This structural fragility is the new reality, and it makes every Bitcoin investor's job harder, because you're not just fighting the macro environment. You're fighting against a broken market structure that amplifies every shock. Everyone wants to know, is this the bottom? Should I buy Bitcoin at 76,000? At 74,000? Should I wait for 70,000? The honest answer is, I don't know, and neither does anyone else. Anyone who tells you with certainty where Bitcoin bottoms is lying to you or to themselves. But I can tell you what the bottom will look like when it comes. We need to see a massive volume spike, 2 to 3 times normal trading volume, as everyone who is going to sell finally sells all at once. This creates the exhaustion that allows buyers to step in. When on-chain data shows mega whales absorbing coins at an accelerating rate, that's a signal that smart money believes we've hit a floor. When Bitcoin ETFs swing from consistent outflows to consistent inflows for 3 to 5 consecutive days, that signals institutional confidence is returning. When open interest in futures markets drops 50% or more from peak, it means the leverage has been flushed. No more liquidation cascades hanging over the market. When fear and greed index hits single digits, extreme fear at maximum levels, historically that's marked near-term bottoms. Fear and greed around 20 to 25 right now. Extreme fear, but not maximum. Volume elevated, but not capitulation level. Whales positioning, but not aggressively accumulating yet. ETF outflows continuing, not reversing. Open interest still elevated, more liquidations possible. We're close, but we're not there yet. The final flush is probably still coming. Let me lay out 3 potential paths for Bitcoin over the next 6 to 12 months. Bitcoin drops to $50,000 to $60,000 range in the brutal bear scenario. We see a severe correction from the recent highs, similar to previous bear markets. This happens if Fed stays hawkish longer than expected, geopolitical tensions escalate into actual conflict, another major exchange or corporate holder fails, creating a crisis of confidence. In this scenario, strategy faces serious pressure. Saylor's never sell strategy gets tested. MSTR stock could drop substantially, creating a true crisis moment. But even in this scenario, if they survive without selling, they likely emerge stronger when the market turns. Bitcoin establishes a range between $70,000 and $90,000 in the range-bound grind scenario. We see months of sideways trading as ETF outflows slow, leverage gets wrung out, and the market digests recent excesses. This is the most likely outcome. Not dramatic, but painful for traders hoping for a quick recovery. In this scenario, accumulation happens slowly. Retail gives up. Institutions quietly build positions. And by late 2026, when macro conditions improve, we're positioned for the next leg up. Bitcoin finds a bottom around $72,000 to $74,000 in the V-shaped recovery scenario. And we see a sharp reversal as whales step in aggressively. Global liquidity improves faster than expected, and the Fed hints at policy shifts sooner than markets expect. This would require a positive surprise, geopolitical tensions de-escalating, inflation data improving dramatically, or a major institutional announcement like a Fortune 100 company adding BTC to Treasury. Less likely, but possible. Markets often bottom when sentiment is darkest. So here's the verdict. After analyzing the data, the liquidations, the ETF flows, the on-chain metrics, the macro environment, and Michael Saylor's underwater position, this is not the end. But it's not the beginning of the end either. This is the middle of the pain. Bitcoin isn't going to zero. The fundamentals of scarcity, decentralization, and monetary policy independence haven't changed. But the market's ability to reflect those fundamentals in price is temporarily broken by overleverage, structural fragility, and a hostile macro environment. If you're holding Bitcoin, don't panic sell now. If you've held this far, you've already endured the worst of the unrealized losses. Selling at 76,000 when you bought at 90 or 100,000 is cementing those losses. If you believed in Bitcoin's long-term thesis at 100,000, that thesis hasn't changed. If you're thinking about buying, don't try to catch the falling knife. Wait for confirmation that the bottom is in. Watch for the signs: capitulation volume, whale accumulation acceleration, ETF flow reversal, fear and greed in single digits. You might miss the absolute bottom, but you'll avoid buying too early and having to endure another significant drop. If you're leveraged, get out now. This market structure is not friendly to leverage. Weekend liquidation cascades can wipe you out regardless of whether your thesis is right. The only people making money with leverage in this environment are those with institutional-sized risk management and 24/7 monitoring. Michael Saylor's position going underwater is not a failure of conviction. It's a test of conviction. If strategy can navigate this period without forced selling, without panicking, without abandoning the strategy, they will emerge as the ultimate proof of Bitcoin as a long-term treasury asset. But if they're forced to sell, if the capital markets cut them off, if the debt comes due, and they can't refinance, then the entire corporate Bitcoin treasury thesis gets questioned. We're about to find out which Michael Saylor we're dealing with. The visionary who was right early, or the over-leveraged bull who mistook a bull market for genius. This is one of the most critical moments in Bitcoin's recent history, not because of the price, Bitcoin has been lower before, But because of what's being tested, can institutional Bitcoin adoption survive a real macro headwind? Can corporate treasuries hold through unrealized losses? Can the ETF structure work when capital is flowing out instead of in? The answers to these questions will determine whether Bitcoin matures into a true institutional asset class or remains primarily a speculative vehicle for risk-seeking traders. The data is clear. The trend is down. The leverage is being flushed. The weak hands are capitulating. But underneath the chaos, the whales are positioning, the long-term holders aren't selling, and the fundamental case for Bitcoin as a hedge against infinite fiat currency creation hasn't changed. This is the darkness before the dawn, or it's the beginning of a longer winter. Watch the data. Trust the process. And whatever you do, don't use leverage in a market structure this broken. This is your narrator signing off. The capitulation is real. The pain is real. But so is the opportunity, if you have the stomach for it. The next 48 hours will reveal whether Sunday's $74,662 low was the bottom or just another step in a deeper descent. Asian markets are waking up as I record this. European traders will follow in a few hours. Then Wall Street opens, and we'll see if institutional buyers step in or if the selling pressure continues. The liquidation data suggests we cleared out most of the leveraged longs below 75,000, but there's likely another cluster sitting around 72 to 73,000. If we break Sunday's low, those positions become the next dominoes to fall. The market is in price discovery mode. Nobody knows where fair value sits in this new macro regime. Is Bitcoin worth 100,000 in a world where the Fed keeps rates elevated for another year? Is it worth 75,000? 50,000? The answer depends on whether you're trading the next 3 months or the next 3 years. For traders, this is challenging. Volatility, thin liquidity, weekend gaps, liquidation cascades. It's a minefield. For long-term investors who understand Bitcoin's role as a hedge against monetary debasement, this might be the opportunity of the cycle. But you need conviction, you need capital, and you need the emotional fortitude to buy when everyone else is selling. Michael Saylor built his entire strategy on one core belief. Bitcoin's supply is fixed at 21 million coins, and governments will continue to debase fiat currency. If that thesis is true, and nothing about this weekend's sell-off challenges that fundamental, then buying below his cost basis is actually the opportunity of a lifetime. But if the market structure is broken so badly that Bitcoin can't function as intended, if liquidity never recovers, if institutional adoption reverses, then we're witnessing the end of a narrative, not a buying opportunity. The next week will tell us which reality we're living in. Watch the ETF flows Monday and Tuesday. If we see inflows, that's institutional conviction. If outflows continue, the exodus isn't over. Watch Strategy's next move. If Saylor announces a Bitcoin purchase this week despite being underwater, that's true conviction. If he goes silent, the market will interpret that as weakness. Watch the liquidation data. If we see another billion-plus liquidation event, we're not done flushing leverage. If liquidations drop off dramatically, it means we cleared the weak hands. Watch the on-chain metrics. If whale accumulation accelerates, if long-term holders increase their positions, if exchange balances drop, those are bullish signals that smart money is buying. Watch geopolitical headlines. If US-Iran tensions escalate, if tariff threats materialize, if any black swan event hits, Bitcoin will likely sell off first, ask questions later. This is not financial advice. I'm not telling you to buy or sell. I'm giving you the framework to make your own decision. Because in markets like this, the only person responsible for your money is you. Stay safe, stay liquid, and may those volatility be ever in your favor. The game has changed, the rules are different now, and only those who adapt will survive. This is total capitulation. But capitulation creates opportunity for those brave enough to act when others freeze. See you on the other side.